I mean, there's always something going on in energy, but there's been a lot more going on lately.
All right, joining me will be Ben Slavin, Global Head of ETFs at BNY Mellon Asset Servicing, who's one of the world's leading ETF service providers. So the best way to think about BNY is they handle everything that goes on behind the scenes of ETFs, things like custody, fund administration, capital market support, sub-advisory. They're in the background ensuring ETFs run smoothly. And they do this for over 2,500 ETFs globally. And because of this role that BNY occupies in the ETF space, I always say there are few people more plugged into the industry than Ben. He's the global head of ETFs at BNY. So he's always one of my favorite people to visit with. And we're going to have a pretty wide ranging conversation on everything from the ETF share class structure to the tokenization of ETFs. We'll find out where Ben believes there's still white space in terms of ETF product development. We're going to cover a number of topics, so I think you'll really enjoy this. Now, to start this week, I'll be joined by our resident energy sector expert, Stacey Morris, head of energy research at VettaFi. And this is obviously perfect timing given everything going on in Iran and in the Middle East right now, where we seem to get a new headline on the Strait of Hormuz every other day. But Stacey is going to break down all of this from an investment perspective and certainly an ETF perspective as well. And I know she gets tired of me saying this, but I'm telling you all, there is not a better resource out there covering energy and energy ETFs than Stacey. If you want to understand exactly what's going on right now, she's going to give us a rundown over the next 20 or 25 minutes. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in the aforementioned Stacey Morris of VettaFi. Stacey, it is always a pleasure. Did I put a little bit of pressure on you with that intro?
No, I mean, I'm flattered. I'll try to live up to it. But it's a treat to be with you, Nate, and appreciate you having me.
Yeah, and obviously we have a lot to talk about. I have to imagine your job is just a tad bit more interesting than usual this year. Is that fair?
That's fair. I mean, there's always something going on in energy, but there's been a lot more going on lately.
Is there any single bigger driver of the energy sector than geopolitics? Like, is that the one thing that can really impact the space more than anything else?
I mean, certainly if you're looking at year to date, then yes, I think there's no argument. I mean, geopolitics are in the driver's seat for oil prices, and that's, kind of been driving the stocks. I would say, it's not always geopolitics, obviously. It feels like geopolitics have been, more prevalent because when we've seen energy stocks working, it's been, 2022 when Russia invaded Ukraine and really kind of this year. So I feel like that's kind of a natural kind of bias or assumption. But if you look at kind of other times when we've seen big oil moves, it really kind of comes down to supply demand fundamentals, right? So during COVID, we had a demand problem with oil, and you saw oil trade down and energy stocks trade down. If you go back to 2014 to 2016, when Saudi Arabia and OPEC decided to fight with US shale for market share, we really had a supply problem. So, sometimes that geopolitical risk premium is more muted than others, but yeah, certainly looking at this year, it's been kind of all about the geopolitics.
Well, let's do this like we usually do. Let's start broader and then we can get into some more detail. And if we look at XLE, the Energy Select Sector Spider ETF, interestingly, this ETF was already up about 25% this year before the initial strikes against Iran at the end of February. Now, once the conflict was underway, XLE did spike up a bit further. I think it hit its peak in late March, up about 41% on the year, but it's since come back down. And so as we sit here today, it's up about 24% year to date, which again was about where it was at before the war started. So I guess first talk about that move up prior to the conflict, because I think some people look at the energy space today and they assume all of these gains have been war driven, but that's not been the case.
Yeah, I think that's probably a misconception that's out there. But you're right. I mean, energy ran up really in January and February. And I think there's, a couple drivers for that. I mean, coming into the year, everyone was very bearish on oil prices. We were at like $56 per barrel in early January. That was kind of close to what the consensus was for the quarter. So we came into the year with a pretty muted outlook, and then oil prices kind of quickly got a lot better than people were initially expecting, and some of that had to do with the different geopolitical factors going on. I mean, Venezuela was a headline. Generally, Venezuela bringing more production on would be kind of long-term bearish, but you did see oil prices start to move as the rhetoric with Iran and activity over there kind of started to heat up. So some of that got, I think, kind of baked in along the way. The other kind of tailwind for energy was that tech was not working at the start of the year. If you look at XLE, there was about 4.5 billion of inflows in January and February. So the space, definitely started to run before the war began. I mentioned Venezuela. There's parts of the energy space that were, more exposed to what was going on there and potential long-term beneficiaries. I'm thinking U.S. refiners that could have more access to heavy sour crude over time. Oil field service names that would stand to benefit from additional upstream investment in Venezuela. So there were some factors like that that were working in energy's favor and helping. But oil started to move before the conflict began, and then once the conflict started, the stocks didn't do as much, and then you saw oil kind of shoot through the roof, as we can talk about. But there was a lot of kind of good momentum for energy, in the first 2 months of the year before the war began.
Yeah, and to your last point there, let's talk a little bit more about that because since the war began again at the end of February, I mentioned XLE did initially spike up another 15% or so, but you look today, it's given all of those gains back. Why do you think that is?
Yeah, so there's a couple things. I mean, I think if you look at, the month of March, XLE or the energy sector was the only sector that worked, right? It was the only sector with gains in March. And so when we started to kind of get some of these reports about ceasefires and potential peace agreements and things like that, I think energy was kind of an easy sell decision for people who were just trying to play it more tactically. And the base case kind of within the energy space is that this is going to be short lived. I mean, if you looked at the oil curve and how steep it was, no one was assuming that oil was going to be over $100 into the summer, for example. So I think that's important context to it as well. But then if you also look at tech, I mean, tech had a great week last week. It's had a nice run up. And so if you chart energy versus tech, when energy peaked, tech bottomed, and then tech has taken off since then. And, energy's kind of just sputtered. And, I think it's just some profit taking and people kind of moving on to the next more tactical trade. But I think that's really why you've seen energy kind of give up some of its gains. But again, still doing really well on a year-to-date basis.
By the way, I should have asked you this right at the top. I mentioned the Strait of Hormuz. And obviously, for people who maybe don't follow the energy space quite as closely as you do, this is what they're seeing in the headline. So I think more people are certainly now familiar with this. But do you mind just briefly explaining the importance of the Strait of Hormuz from an energy perspective? Like, why is this so important?
Yeah, so definitely anybody who spends time in energy knows about the strait, but I appreciate that the typical person probably hasn't thought about it too much. So the Strait of Hormuz is a major choke point for a lot of energy movements. You essentially coming out of Iran, Qatar, etc., Saudi Arabia. So just typically you see about 20% of world petroleum consumption go through the strait. And I say petroleum because a big chunk of it is crude oil, but there's also refined products like diesel and jet fuel, et cetera, that come through there as well that I think people kind of miss. They think it's just all oil. Another big factor there is LNG, liquefied natural gas. About 20% of global LNG supply comes through the strait, namely from Qatar. And then you've also got big movements of liquefied petroleum gases or LPGs. Those are essentially propane and butane that also come through there, over 1 million barrels per day easily. And then it's also a big conduit for fertilizer, which is beyond my scope, but maybe bears mentioning because you've seen some talk around that impact for agriculture, etc. But for energy, it's just a major, thoroughfare essentially. And in the energy space, we've always kind of known that that's an important choke point. We've been sensitive to risks of it closing. But typically, it's just always stayed open, and those risks have always kind of been avoided. But people in energy have always kind of known this is the main kind of card that Iran can play. And so we've seen that play out, and it's been somewhat really essentially unprecedented, because historically this strait has generally been open, and kind of the worst case scenario has been avoided, and now we're kind of seeing that worst case scenario from a supply standpoint.
The other aspect of the conflict I was going to ask you about, something that I think a lot of people are seeing in the headlines, is just some of the damage to the energy infrastructure in the Middle East. Now, I know there's been a lot more threats in terms of moving forward on both sides, talking about damaging energy infrastructure, but how big of a concern is that?
Yeah, so I think when we came into the war, the question was, how long is the strait closed and what damage is done? And I think from a damage perspective, kind of the biggest story has been around actually LNG and a Qatar facility that saw damage and expects to have about 17% of its capacity offline for 3 to 5 years. So that's going to have kind of more of a lasting impact, assuming that kind of initial assessment is correct. I think it's hard to get a good sense of some of the damage that's been done to infrastructure, because who's really there on the ground doing engineering studies and really kind of figuring out what's going on. My impression is that the oil infrastructure hasn't really been damaged significantly. Otherwise, I think you'd see a higher kind of back end in the oil curve. So for example, with WTI, I think we're at $89 right now on the front month, but if you look back at the September contract, or further out the curve, we're back under 80. So I don't think that the damage to the infrastructure is going to be that bad on the oil side, based on kind of what I've seen. But I think it's also hard to get a really good read on some of
Okay, so coming back to the investment side of the equation, more specifically the ETF side of the equation, we talk more broadly about XLE. And I was filtering through a number of energy related ETFs. And one thing I noticed is that the oil and gas equipment and services ETFs, they've actually done much better than the broader energy sector. So I was looking at something like the VanEck Oil Services ETF, OIH, that's up over 40% year to date. Is there any particular reason for that?
Yeah, and that's like an interesting one too, because most of its gains were really in January and February. Like since the war started, it's bounced around a little bit, but it's essentially kind of flat. So the story on OIH and oilfield services, I think, is in one part Venezuela and the potential for investment there, and that potentially creating some opportunity. The higher in price environment and all that, you could argue, is also going to be helpful for increasing activity around the world, which can benefit oilfield services. But also, this is a space that had kind of been a laggard. I mean, oilfield services can be pretty sensitive to what's happening with oil markets. It lagged the XLE in 2024, it lagged in 2025, and it had really kind of been plagued by these downward earning revisions and trying to find a bottom in terms of earning estimates and activity. And so I think we finally kind of found that bottom, and the outlook started to improve for the oilfield service space. And that's why you saw kind of these big gains. And again, it tends to be a little more sensitive to what's kind of going on with the commodity. So I think that's some of the key factors for oilfield services. That's somewhat independent of the price spike and what we saw with the war.
Okay, and then the other category of ETFs I was looking at, which just won't surprise you at all because we always talk about these MLPs. And notably, relative to other energy related ETFs, MLPs have underperformed this year. So, for example, the Alerian MLP ETF, ticker AMLP, that's only up about 11% year to date, which, by the way, that's obviously much better than the S&P 500, which is up 4 or 5%, but it is still lagging fairly significantly behind ETFs like XLE and OIH. Is there anything that you would point to there?
Yeah, well, there's a couple things on the MLP side. I mean, first and foremost, these companies are providing services for a fee. They're not supposed to give you a lot of commodity price exposure, so they're actually doing what they should, in the sense that They don't get a lot of upside when commodity prices move, but they also don't get a lot of downside when commodity prices come down. And so the thing about MLPs and kind of the energy infrastructure space more broadly is that these are supposed to be stable cash flows provided by fee-based businesses that operate under very long-term contracts. So stable cash flows is actually kind of the cornerstone of this space, and it's a good thing. But it's not going to give you the exposure to oil prices jumping really. And so that's why you haven't seen MLPs necessarily move as much as the rest of the energy space. But I'd also mention that it's more of an income play. AMLP's underlying index is yielding around 7.2% right now. So I think you were citing price return numbers. If you look total return, it's maybe more like 13% year to date that the space is up. And so that's another kind of element to keep in mind as well. MLPs tend to be more of an income tool because they generate those stable cash flows and they use that to essentially pay out distributions or dividends to investors. So it's certainly not the space you want to use if you're trying to play a higher oil price move. But if you do want kind of long-term exposure to the energy space and a nice yield to it, that's more where MLPs are going to make more sense versus, you'd probably want oil and gas producers if you're trying to chase a commodity price.
All right. So I think we've done a nice job of setting the overall backdrop here. Let's look ahead a little bit. And obviously, nobody knows exactly how this Iran situation will end up. I mentioned we get new headlines every single day. I can barely keep up with everything here. But I guess I'll ask you, talk about some potential shorter term implications of this conflict, and then maybe some longer term implications for the energy space overall. Like, what are some of the main things that you're watching here?
Yeah, so I think in the near term, it's still, watching the headlines. When does the strait actually open, and when does energy start to flow? What are oil prices doing? What are LNG benchmarks doing globally, particularly in Europe and Asia? That's where we've seen obviously price spikes. So I think near term, it's still kind of watching those prices. If you look out, a little bit further, I mentioned the oil curve earlier. We saw the WTI curve shift up since the conflict began, even in kind of the further out years. So 27 to 28, oil was around low 60s per barrel, and now it's closer to $70 per barrel. And so, to me, that's good for midstream from a production standpoint. It probably bodes well for U.S. production growing more meaningfully into 2027. As I mentioned, coming into the year, everyone was pretty bearish on oil. There were concerns about U.S. oil production declining a little bit, or essentially at least flatlining. And I think a lot of those have been alleviated, and the EIA, the U.S. Energy Information Administration, has come out and basically bumped up all their production estimates for 2027, including now projecting a new record high for oil production in the U.S. next year. So seeing those kind of impacts play out over the medium term from what's likely to be a higher for longer price environment, I think is something to keep watching. Another question is, do we see a lot of countries come in and try to refill their strategic petroleum reserves? There was a big, coordinated release by the International Energy Agency. And so, the US SPR is down quite a bit in terms of what inventory was there. Other countries have been depleting their reserves. So if we see countries start to restock over time once things kind of normalize, then that also kind of helps put a floor under oil. I think if you look longer term, some of the implications are going to be around energy security and a renewed focus on that. We kind of saw energy security come into focus after 2022 and Russia's invasion of Ukraine, but I think that's going to stay topical. And politicians are going to have to think a lot about kind of the energy mix that they want to have. I think North America becomes a preferred supplier for global energy importers. We don't have the same kind of geopolitical risk and issues that we've seen in the Middle East. So that probably supports more expansions of U.S. and Canadian LNG capacity, exports of things like LPG, like I mentioned, propane and butane. The U.S. is a huge exporter of those. So I think those could, kind of play out in longer term as opportunities as well. And then also, in the medium term with that Qatar facility offline, LNG market is probably going to be a little better balanced. Like everyone else, like very much like oil, everyone else was expecting LNG to be oversupplied, and now that math has kind of changed a little bit with the damage to the Qatar facility too. So those are all kind of some of the things that are in the mix over kind of the short term to the longer term.
Just a few minutes left here. I'd love to have you unpack the point regarding energy security, how this conflict might bring that back into focus. Can you talk a little bit more about that? Like, what specifically might that impact?
Yeah. So, I think globally, different countries around the world are always trying to solve for this energy trilemma of like having reliable energy, affordable energy, and preferably clean energy. But when we see price spikes like we see right now, it tends to be more about reliability and affordability. And so you look at something like nuclear, for example, the nuclear renaissance that we're seeing today was really kind of born out of what happened with Russia and Ukraine. And in 2023, you had another number of countries sign a declaration to triple nuclear energy by 2050. Part of that was climate, but part of it also was just energy security. A nuclear facility only has to refuel every 18 to 24 months. It's not like a natural gas or coal plant where you have to kind of constantly feed it. So nuclear, I think, is kind of another kind of long-term beneficiary here, and already has a lot of tailwinds in the US, especially from a policy standpoint, but globally, there's a lot of policy support around nuclear. And I think, that only kind of continues to see momentum as energy security comes to the forefront. Another area that, is kind of interesting and a lot of off the radar for a lot of people is coal. Coal generally has not had these same kind of geopolitical issues that we've seen with oil or LNG. And it's, pretty reliable, pretty decent, power source in events like these. And again, the concerns about climate and emissions kind of tend to go to the background when, people are just trying to keep the lights on. So I think coal is kind of another long-term beneficiary here. Prices have gone up, since the war started, but, nothing like what we've seen with oil or LNG. And so we have the index for a coal ETF. It's had over 60 million in inflows year to date. And I think it ended last year at about 30 million in assets. So it's just kind of been an interesting area that's also gotten a lot more attention because of the war and people kind of realizing that you need things like coal in your energy mix to offset maybe some of the volatility that you might see on the LNG side. So those are just, I think, some of the examples of areas that are maybe going to make sense, for quite a long time from an energy security perspective, just again, to kind of keep the lights going on. And you kind of opposite ends of the spectrum with nuclear having, no emissions during power generation and coal kind of always being painted as a black sheep. But I think we learn in these kind of situations that you need diversified energy sources and you don't want to be overly reliant on one supplier or one type of energy. And so I think that's a takeaway from what we're seeing right now too.
No, I think two really interesting areas. I just pulled up performance while you were talking there. So if you look at you probably already know these in your sleep, but the Range Global Coal Index ETF, ticker coal, great ticker, that's up nearly 10% this year. Again, S&P 500 is up about 4%. And then you mentioned nuclear renaissance. Of course, there's the Range Nuclear Renaissance Index ETF, ticker nukes, another great ticker symbol. That's up 15% this year. So I think to your point, clearly investors may be looking ahead, looking long term. These are two areas that are getting some attention. But Stacey, we'll have to leave it there. Again, I always appreciate your insight into energy. I really mean it. Nobody is better. So thank you for joining me.
Thank you so much, Nate. I appreciate it.
That was Stacey Morris, head of energy research at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Ben Slavin, Global ETF Industry Lead at BNY Mellon, who, as I noted at the top, they are one of the world's leading ETF service providers. They handle custody, fund administration, capital market support, sub-advisory. They do it all for some 2,500 ETFs globally. And Ben is a humble person, but I will tell you, there are a few people walking the face of the earth that know more about ETFs than he does. He's probably forgotten more about ETFs than I know, but he's now joining me from New York. Ben, it is always great to have you on here.
Great to see you again, Nate. Thanks for having me back on ETF Prime.
All right, so you and I are going to take a little tour around the world of ETFs. And, as I was thinking about our conversation, I just thought I'm going to start in the same place that we usually do, which is with the ETF share class structure, because this is something you have been on top of from the very beginning. I would say going back to when issuers first started even considering this, when we had the expiration of the Vanguard patent. And I feel like as regulators seem to be getting their head around everything here. And we're now starting to see this roll out, right? Dimensional, Thornburg, FM Investments, and of course there will be others. And so to start here, I'm just curious, how much has this topic been a part of your conversations with clients recently?
Nate, it's coming up on a daily basis. So the way to think about it, or maybe the place to start, is the stats. 99 applications are in. Could somebody please just file the 100th, just so we can cross that triple-digit threshold? But 99 in. I think 70 have been approved. 7 have filed a prospectus, sort of taking the next step forward at issuing a share class. And as you mentioned, the few that have actually brought them to market. So the structure is getting a ton of press for good reason, but and these conversations are coming sort of fast and furious. But I think the launches and the implications for the industry are going to play out over the next several quarters, actually the next several years. So, we are having those client conversations, but anticipate really a slow rollout of these share classes. And there's quite a bit here to consider for the asset managers, but there's also some structural issues that are going to slow down sort of the rapid launches of these share classes. One is certainly just the operating model required to do so. Certainly those ETF managers who are already in the business of managing ETFs are ahead of the game, but there is some more work to be done to fuse that together with the unlisted mutual fund share classes and tweak or update your operating model to be able to do so if you're an asset manager. Second, what we're hearing from a lot of clients is really around the readiness of the platforms to be able to really handle ETF share classes, and maybe most importantly, those share class exchanges. Now, there are lots of benefits to talk about, which I'm sure you've covered, certainly recently in the past, but that exchange privilege is also something that's quite unique and obviously one of the shareholder benefits. And simply put, the platforms aren't quite ready yet. And I think part of the underpinning is not BNY. We are ready and able to serve our clients, but the platforms are a little bit of a different story. And all of the work that's being done by the ecosystem, specifically with DTCC, and the upgrades they're making to their system, is really a key component here to be able to automate and standardize that share class exchange process for the platforms. But once that work is done, which we anticipate is going to be done by the end of this quarter, then at that point, the platforms really need to pick up those new files, those new tech specs, and effectively do things from a technological standpoint on their side to be able to do this. And it's going to take some time, and they're going to work ultimately at a different pace depending on the individual platform.
So let me ask you about a couple of the points you made in a bit more detail. And you mentioned considerations for asset managers. And I'm curious, what are some of the aspects of this that maybe aren't getting enough thought or attention from asset managers? Because you know very well, you don't just push a button and magically have an ETF share class of an existing mutual fund.
No, far from magic for sure. I think a lot of the traditional topics have, certainly been well covered. Does this strategy make sense, right, for to put into an ETF wrapper, or in this case, to launch a share class? I think there are certainly fee implications. Can managers be able to live with the transparency that's required? These kind of typical things you see with ETFs. Another, though, more, I think, a deeper kind of analysis when you are, from an asset management perspective and also from a shareholder perspective, is really doing a deep dive on the taxation front to really understand the potential benefits as well as the potential risks from a tax standpoint, depending on sort of the nature of the flows, the underlying embedded capital gains that may be inherent in the existing fund. Another issue I think that's slowly going to emerge as we see some products is also potentially the impact on secondary market liquidity. Look, this is new, and I think from a spread standpoint, it might take some time for the market really to kind of understand how to sort of deal with the information flow and the informational friction, because now you have to worry about this other thing, which is that unlisted class, and fusing that together with sort of the ETF quote unquote baskets is something that's going to be new for the liquidity providers and market makers. And I think, there could be a situation where you have, impact on spreads. And finally, I think, back to the tax issue. I think one other point I wanted to make is really on that, rebalancing period tax efficiency is another place to watch. And I think the bigger issue is not that the mechanics work; they do, and I think that roadmap is sort of well defined. But I think the bigger issue is simply the balance sheet available, which is finite. And if you see a high, as these products start to proliferate on top of the record product development pace that we've seen in the industry, so there's only so many market makers, only so much balance sheet to go around. We have not seen that be a limiting issue for the industry, nor have we seen it for share classes. I mean, there's only been a few launched. But again, another little space to watch for managers to be able to really understand their liquidity provider partners and the constraints. And then again, for shareholders to keep an eye on things from a liquidity and tax standpoint, to do your homework as these products come out.
The other area you were talking about earlier is just this platform readiness. And you were talking more just about how these platforms are going to handle, say, moving from a mutual fund share class to an ETF share class. I actually want to ask you more about the distribution side of the equation. And you may recall we had a brief conversation around this at the exchange conference back in March. But the way that I would lay this out is, of course, mutual funds can pay 12b1 fees. They can pay for shelf space, which that obviously helps facilitate distribution. But ETFs don't typically pay these fees. And we always say distribution is king when it comes to the ETF space. And so I'm curious, how do you see that playing out moving forward? I feel like this isn't getting talked about enough.
It's a huge issue. Just looking at ETFs as a whole, before we even get to the share class, as you well know, and a lot of industry, long timers know, ETFs are disruptive for a variety of reasons. And this is just sort of another example or another area where they're really disrupting the industry. And certainly from a distribution standpoint, that's exactly what we're seeing. So again, before we even get to the share class, the structural shift of assets moving out of the mutual fund structure into ETFs is already causing the disruption and to some degree the pain, right, on the distribution platform as their revenue model is shifting quite quickly. And again, share classes are just going to add some more sort of fuel to the fire. And so I think we're seeing a wide range of different approaches by the distribution platforms. Certainly, I think it's fair to say that all of the platforms, nobody likes to lose money. They're always going to like to look to recoup those fees. And there's different approaches that these platforms are trying to do that. I would sort of hesitate to say that there is a broad consensus across the industry that says, hey, this is sort of what's happening out there. The battle as we speak is being fought out in the field. That friction between the advisors, like yourself, Nate, the platforms and the asset managers are all kind of in the ring together, duking it out. And the question is, who's ultimately gonna pay? Some of these things are not free. And as you mentioned, Nate, look, there's just not as much to go around in ETFs from an expense ratio standpoint, which is one of the reasons why everybody likes it in the first place. But I think when you're certainly from an investor standpoint, platforms and to some degree the pressure it's putting on the industry is a different story. And I do think, it's going to be interesting to see, but certainly the need for asset managers to pay for that shelf space is, not something that's a mystery. How much and the nature of it, we'll see. I think, the ability for different managers to pay, I think will be interesting in terms of not only the economics, but also will some of the smaller and upstart, type of issuers also be able to step into the ring with the larger players to keep that breadth of product, breadth of choice, all the different products we love to chat about, the niche products, thematics, other things that maybe aren't sort of the behemoths, but absolutely serve a purpose. And we want to make sure or hope that those products also find their way or maintain their ability to stay on the shelf. So it's a tricky one, but the battle's being fought right now. This is the space to watch probably in 2026.
100% agree. I keep saying this is a huge story. We're already seeing examples of some brokerages implementing pretty sizable commissions on certain ETFs. This whole pay-to-play aspect is something that it's kind of been the industry's dirty little secret. But I've always said, and I won't get on my soapbox now, we can talk about it at another time, but there's a huge misalignment of incentives, I think, across the industry. And the way I would describe it on a lot of these brokerage platforms, they do receive revenue from pay to play. They receive revenue from payment for order flow. They receive revenue net interest margin where they're parking client cash into low or non-yielding sweeps instead of higher yielding money market funds. And then I think about somebody like me. You mentioned I have an advisory firm. We don't pay anything to these custodians. And that doesn't seem right to me either. It seems like advisors should have some skin in the game and pay for services that they're receiving from custodians and the customer service and everything else. And then advisors can make the determination as to whether or not they want to pass that on to their end clients. My point is just shine a big light on all of these fees so end customers know exactly what they're paying. And that's always been my gripe from the very beginning. There's all of these things going on behind the scenes that that are, again, less than transparent. So I'll get off my soapbox now, but I think this is something that, to your point, everybody's in the ring now together, and the industry is going to have to figure this out. I'll let you comment on that if you'd like.
Yeah, no, I'm definitely on, in many ways, on your same soapbox. So hopefully you left a little room for me there. But I would just say, look, I think you said it perfectly. But I would only add that, that transparency comment at the end, I think is really important too. I think, again, one of the hallmarks of the ETF industry and one of the reasons why investors like the ETF wrapper is the transparency that it affords, not only from a fee perspective, but of course also from a portfolio perspective as well. I just think the fees, once you get beyond the underlying ETF itself, again, as we were talking about in that sort of battle ring that we were both just talking about, is much less transparent at times, or can be opaque for that matter. And bringing that, I think some of what's happening in the industry, or this friction we're talking about, is bringing some of that to light. And, I think it'll be, again, a really interesting space to watch.
All right, one more quick question regarding the ETF share class structure. Really, this is a broader question, but I would say the vast majority of the ETF share classes that'll come to market will obviously be for actively managed strategies. I would say a lot of traditional active strategies. And I'm just curious how you think issuers should be pitching their value proposition in this space, just given the growing number of products. And I think this is a topic I continue to harp on. just because I feel like the industry has celebrated this rise of active ETFs, which, by the way, I think is fantastic. But from an investor perspective, it is becoming very tough to differentiate between all of these strategies. And so I'm curious from your perspective, how can issuers do that? How can they help investors differentiate?
It is not easy for anybody here. If you're an asset manager, the noise in the market at an all-time record, and it does not seem to be abating. I mean, what 1,100 plus products launched last year. We're roughly on the same pace this year. If you're an investor or a platform, by the way, trying to diligence what makes sense in an ETF model or what belongs on your platform, same problem. It isn't getting easier. I've heard certainly and talked to many platforms, especially around the share class issue over the past several months. And it's not like they are tripling, quadrupling their staff to handle the volume. There's the same handful of people that are trying to deal with the flow. So it's really complicated to rise above the clutter. I do think that, setting aside just the whole set it completely aside the whole active passive debate, sort of think there's room for everything here. But again, lots of, certainly depends on a wide number of factors. But ultimately, I think from an asset manager standpoint, and to a lesser extent, if you're an investor, what the share class, one of the benefits of the share class is for actively managed products is porting over that live track record. So I'm going to assume that if you're launching a share class, it's probably decent, if not really good. If it was poor, probably less likely to take a shot at doing it. Why do it? Obviously, if that track record is underperforming. So most of them are going to look good to excellent, but it does provide a better way to evaluate a particular active strategy versus zero track record or maybe even hypothetical performance in some cases, depending on the regulatory ability to do so, depending on how you show it and what you can show. But ultimately, the fact of the matter is that share class has that live track record. So it does provide at least that benefit to be able to help evaluate. And I'm assuming, again, I think it's fair to say that the track record likely will be good, or again, you wouldn't necessarily bother. So that is one of the things that I think asset managers are hanging to some degree their hat on, at least in certain cases where the share class would make sense. But wow, it's getting tougher by the minute, it seems like, to be able to rise above and find your niche from a distribution standpoint. As much as I like to say that, hey, we had a record Q1. So, the money just keeps coming in, and the rising tide more or less has been lifting almost everyone's boat, in the last, in recent times, but Q1, no exception.
That's an excellent point regarding the portability of the track record. And I probably haven't given that enough consideration because you're right. Ultimately, I would argue that in active strategies, performance is king. And being able to look back, especially if you have a really long track record, that is a differentiator versus maybe active ETFs that have come to market more recently that don't have that track record. So I think that's an excellent point there. Okay, if we move on to another big topic of conversation across the ETF space, I want to ask you about tokenization. So, of course, FM Investments, they have filed with the SEC to tokenize shares of their Treasury bill, ETF T-bill. And Ben, I mean, we're now seeing initiatives from major exchanges such as NYSE and NASDAQ around tokenization, the DTCC. And so, given everything that BNY does around custody and fund administration and capital markets, how is the firm thinking about tokenization moving forward?
Yeah, another hot topic that seems to come up almost on a daily basis. The call or the meeting I just had directly before talking to you, Nate, was with a large asset manager. And the first question was, tell me about active ETFs. Second question, tell me about share classes. Third question, what are you guys doing in tokenization? And tell me about that. I mean, in that order. So you're spot on, always spot on, Nate. I would say just quickly from a BNY perspective, I mean, look, we're providing a range of services to support our clients for various versions of tokenized products and funds. including our own as well. Offering a stablecoin reserve fund, designed to, really support clients and stablecoin issuers who are operating, under the Genius Act, et cetera. But I would say you mentioned a few of the key players that are happening around the ecosystem. You mentioned DTCC, you mentioned NYSE as another one. I think these are really important steps at being able to effectively get the plumbing and some of the regulatory framework working to really start to accelerate sort of the adoption. And I think it is no doubt in my mind that the industry is taking note, hence all of these conversations. What you've primarily seen, and again, a lot of the, not all, but most of the support that we've given to clients to date in and around the ETF and fund topic has mostly been around money market or money market like funds used primarily for collateral. We've seen some early iterations from sort of BlackRock, Franklin with the Benji product, Wisdom Tree with their digital funds via the Prime, sort of Wisdom Tree Prime, which is kind of their own ecosystem. So I do think you are seeing these different iterations. I think the next one of the next things that we are going to see and have come up in those conversations have been, again, mishmashing all these topics together, is the tokenized share class. Again, as you mentioned, FM being one, another area that's taken note. And I would also point out that, again, we're focused here on the US ETF market. Big world out there, lots going on in Europe and in Asia. And the same exact topic around tokenized share classes or being able to tokenize ETFs is also happening in Europe as a way to look at tapping into some of these new distribution channels or find new use cases for the product. So it's really a large degree of global phenomenon. So again, some of those infrastructure, like again the DTCC no action letter, NYSE, some like NASDAQ, some of these other things that are happening, super important for investors here, but it is not limited to US. And I think asset managers are thinking about this from a global scale, especially the larger ones, versus even just tapping into the US market.
So let me ask you the cliche question here, which is, will every ETF eventually be tokenized? And I guess along with that, Ben, is it an either or scenario? Like, will tokens eventually replace the ETF wrapper? Or is it what you were saying earlier that, these will live side by side? It's more of a tokenized share class, and you have a token distribution strategy if you're an issuer, but maybe you also have the traditional wrapper. Nobody knows the future, but how do you think that might play out?
Yeah, I don't know. Why can't we all just get along, Nate? I think these can coexist together in harmony. I would say, will everything be tokenized? It's a tough one. I do think I'll answer it this way. It will not everything will be tokenized probably by the time I retire, but while in my lifetime, I think the answer most likely is going to be yes. I think there's a lot of work to be done behind the scenes to be able to make that happen. I also think beyond just simply tokenizing, an ETF or a fund or some other security, easy to say or easy to do. I think what's probably the longer burn, again, especially speaking from a BNY perspective, is all that important work from an infrastructure standpoint that needs to happen to effectively facilitate it all. And we have a ways to go where, again, we're in a world where ETFs are trading, natively on chain, effectively TradFi, and all that infrastructure is sunset. DTCC has shifted everything over, again, on chain. And we are, in that sort of truly sort of next gen native environment, exclusively. Probably have a ways to go for that.
All right, just a couple of minutes left here. I'm going to close with the same question that I always ask you, and I think you'll already know what this is. It's around ETF innovation. And the question is, Ben, where is there still white space for ETF issuers? Because you sit in all these conversations, you hear all of these ideas, you have your finger on the pulse of the industry. So tell us where you think product development is heading next.
I mean, every time I think I've seen it all, like it just here comes something else. Good. It's a good question. I mean, look, we spent some time, so we don't need to rehash active, right? Well covered, super noisy. There's plenty of space there, obviously, though, to continue to grow. I think, certainly we've seen, and again, something you've also well covered on your side, but doesn't seem to be a slowdown or a shortage of appetite in the digital asset space. Our pipeline continues to remain strong. We service the vast majority of those products. So kind of really been in many ways the go-to spot to help bring those products to market. We just keep seeing innovation there. So I think I think basket products in that space, products that are sort of ripping a page out of the successful playbook we've seen in other assets, or other areas like using options to add income, hedges or buffers, super popular, and other ways to be able to mix digital assets alongside other assets in multi-asset portfolios. Private assets, probably a topic we're not going to have time to deep dive into, maybe for the next time, Nate, but the attention and the demand clearly seems to be there. The reality on the ground is probably something clearly more challenging, to because of liquidity and other factors. We've seen some early iterations that have certainly made some headlines, but I'll just point out there certainly is room there for more innovation, and I do see clearly there's demand there into the market. So without a doubt, those are, sort of a couple areas. And certainly, I mean, maybe I'll just end with two quick things. One is I will say thematic never ceases to amaze me. It's had its moment, then it's quieted down, then it picks up again. Then you look at a product like DRAM. I mean, what a story. I mean, wow. And, something that just finds that area, right time, and which helps from an asset raise, but finds this new area, and, you see success. And so that success has still captured the imagination of our clients. So no shortage of ideas trying to chase it. You can't always get the timing right. Actually, it's almost impossible. So kudos there. But I would say that it has not slowed down that need to innovate. And I would say finally, I did allude to it when we talked about tokenization, but a really incredible amount of cross-border discussions happening these days. US managers looking to tap into distribution channels around the world. But I would also say a reasonable amount of managers who are either headquartered or wholly domiciled outside the US that look at this market and say, wow, I'm seeing the growth. I want a piece of that. And I'm trying to bring something, export something from overseas into the US market. I wouldn't say there's going to be a flood of those, but I do think there you will absolutely starting to see some names pop up that really aren't don't have a large brand or even a presence in the US that are going to try to bring some innovative strategies or hope to bring some innovative strategies into the US market. But distribution challenges, building your brand, trying to rise above. It doesn't make it any easier for those guys, but it will create some innovative product coming into the market.
I love you calling out the DRAM success. For people who are unfamiliar, that's the Round Hill Memory ETF, launched a couple of weeks ago and already has over $1 billion in assets. And I think that's such a perfect example of how ETF innovation never ceases. There's always something, there's always product development, always something coming to market. But Ben, I think about what we've covered here today. So ETF share classes, tokenization, we talked active ETFs, digital assets, private assets in ETFs, thematic ETFs. You talked about this global, wave of interest around ETFs. That's a pretty good tour through the ETF landscape.
I think we covered literally, I think, around the world, the full tour. I think the only thing we didn't talk about is who the Chiefs are going to draft this week. But, maybe that's a separate conversation. But other than that, we really did hit just about everything, it seems like these days.
Well, Ben, I always enjoy conducting so much fun. Thank you for joining me.
Thanks, Nate. Appreciate it.
That was Ben Slavin, Global ETF Industry Lead at BNY. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. I have two excellent guests for you next week. I'll be joined by Lance Humphrey, Head of Portfolio Management with the Victory Shares and Solutions team. So we'll, of course, be talking Victory Shares ETFs. And then I'll also be joined by T. Rowe Price's Dom Rizzo. So he's a portfolio manager for the T. Rowe Price Technology ETF. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.